lot of talk in my industry about indexing, index investments, passive investment management versus active investment management. There are strong opinions on all sides, but I think what happens is we forget that most people don't understand what the difference is at all. So I'm going to try to briefly explain the difference. Back in the day, in the 1930s, when mutual funds were first invented, mutual funds are a way for investors, small investors, to get involved in the stock market by pooling our money together and hiring an investment manager to decide what stocks to buy, when to buy them, when to sell them. That's a mutual fund. Back in the early days of the fund industry, really probably up until the 1980s, those were always actively managed. In other words, there was a dude, it was always a guy, that was surrounded by some minions, some analysts. And the analysts would do research, and then they would tell the guy what they thought about certain stocks. What's a good price to buy? What's a good price to sell? And that's what they would eventually do. So you as the investors trusted those decisions, when to get in, when to get out of certain investments, and you just went merrily along, letting your investments do what they're going to do. That's how mutual funds worked for a long time, and that's called active management. In other words, someone is researching and forming an opinion and thinking about and acting on when to buy and sell certain stocks. Now, about in the 1980s or so, I guess, index investing came along. And index investing simply means someone is going to create a list that represents a certain area of the market. That list is called the index. The one you might be most familiar with is the S&P 500 index. The Standard & Poor's company has a list of the 500 largest companies in the U.S. by market capitalization, and that is the index. And that's kind of how we track the overall health of the U.S. large company stock market, as we watch what the index does going up and down. Some clever people decided, hey, you know what? As an active fund manager, I may not be able to always beat the index, what the overall stock market is looking to do. Sometimes I might beat it for returns, but other times I might fall short. You know what an easy thing would be to do is just invest people's money in the list or in the index. Therefore, index funds were born. So as you might imagine, index investing means that you will not do any better than the overall stock market or index that you're investing in. You won't do any worse either. You'll do the same. And because index investing is basically mimicking a list that's already published and out there, it doesn't require a lot of decision making to manage the money in the fund. The big head honcho fund manager doesn't need to be surrounded by minions of analysts deciding and researching and giving recommendations. All he has to do is sit at a computer and plunk money into the, say, 500 largest US stocks. Pretty easy. Therefore, index investing, not only does it follow exactly what the market does, it's also less expensive. Your internal expenses to your mutual funds are lower in an index fund than they are in an actively managed fund. So then comes the question, which is better? I believe in gray area. I don't believe there's always a better or a worse kind of investment. I think it depends on the area that you're looking at in the market. So don't believe all the media hype that only index fund investing is good or only active management funds are good. Probably a combination of both in your portfolio makes sense, depending on the areas of the market that you're concentrating in. This is something to discuss with your financial advisor and get more advice on, but at least now you know the difference between index investing and active investing.